my gosh, they're all here. This is so exciting. We haven't done this for a long time. Why is that? Oh, no COVID. That's why. Well, actually, there is COVID. Still, everybody's, I think, probably, what, 30% of you have COVID right now, but don't know it, and the other have a little sniffle. So thank God for that. But I think it's so interesting that, you know, we were able to do this power lunch throughout COVID, and people still ask us about this. And we really,
Carol,
really didn't,
do you want me to open the garage door? I thought you could do all this.
Sure.
so push mute if you're not familiar with how Zoom works. If you're not on the panel, you should be muted.
Yeah, well, my dad was in the.
You'd think we hadn't been doing this for 3 years, right? That's awesome. That's amazing. So this is really exciting. We're thrilled to have everybody back. I have my law partner and the head of our transactional department, Cameron Carter, here with me to moderate this great panel today. And we decided, just because there was such unease and some sort of uncertainty in the market, in the real estate market, that we should get back together for a power lunch discussion, because those were so effective during COVID, and we had started these during COVID every week just because we wanted to see people and interact, and now we just want to kind of get on top of what's going on with the market. So let me introduce our panel today, and if you could push mute if you're not on the panel, and then I would also and hopefully Madeleine here from my office can start keep admitting people that are in the waiting room. I see there's a process there. So we have Elliot Pollack. He's Arizona's premier economist, the CEO of Elliott D. Pollack and Company. Michael Frenchy Lemieux, the senior division president of Richmond American Homes. Thank you, Frenchy. We have Nate Nathan. Nathan and Associates, powerhouse broker, does it all. Thank you. And John Bradley, the president of Brookfield Properties, Arizona Land and Housing. So thank you, John. And we've got a great panel of experts, and I think the whole audience is full of experts. So I know everyone knows how to use Zoom now, and when we were doing this during COVID, people didn't, but we're encouraging you all to keep your cameras on because it's more exciting, and also encouraging you now to send me directly questions for our panelists, because I think as we talked beforehand, we want to be able to address really what the concerns of the real estate market, the real estate community, and the business community are. So just send me directly some questions. But let's start off. With Elliot. And Elliot, can you maybe? Well, first of all, let me just ask, where are our panelists? Is everybody here? Frenchie, Nate, John, Elliot, you guys are all in Phoenix, is that right?
No, I'm in Coronado.
Right, because Nate is Nate, so Nate is smart. So
I'm here temporarily, yeah.
Okay, so Elliot is temporarily not smart.
In Phoenix.
Yeah, but all of the rest of us are
Welcome
in
to
Arizona.
Zoom.
sweating
Enter
it
your
out.
meeting ID followed.
Okay, push mute if you're not a panelist. Okay, Elliot, let's talk about the state of the state. Will you kind of give us an idea of
Enter your participant ID.
Okay,
Well,
somebody's,
maybe Madeleine.
Ryan's trying to get in.
You are in the meeting
Can
now.
you mute people
There
for
are
us?
more than 210 participants in the meeting.
Okay.
This meeting is being recorded.
All right, well, let me start by saying that what you should be doing is keeping your eye on the ball, not what the media is telling you. And the ball is that the demographics for housing remain sensational. Not only is the largest cohort of the population, which of millennials, basically they're 27 to 32, they're in prime home buying years. They're not going away. They might rent for a while, but they're going to be back. 46% of all people between 18 and 29 are living home with mommy and daddy. That's the highest number since the end of the Great Depression. And so they will ultimately come back to the market. Vacancy rates are extremely low and they're not getting much higher. And despite what you read in the media, there has been some recovery in the shortage of housing, but not much. We are still in a seller's market, and that's not going away quickly. So the underlying, nothing that caused the boom in housing has changed very much. It's now being delayed because of interest rates. Interest rates are going up. They will probably go up for a while longer. It's taking longer because the underlying economy is so strong. Consumers have $2.3 trillion more than they normally have at this point in the cycle. And that's mainly because the $1.9 trillion that Biden put in right after he was elected was totally unnecessary. And it just created, again, too much money chasing too few goods, which is one of the reasons we're here. The other reason is the Fed. And on top of that, there's still 11 million unfilled jobs in a country that's only got 6 million unemployed. So again, the underlying strength of the economy is very real, but and especially for the housing market and especially for Arizona. That being said, Arizona is not going to be able to avoid the national recession, which is a fait accompli, and we'll talk about that in a minute, nor is it going to be able to slow or avoid a slowdown, albeit temporary slowdown in population growth. And that's simply because about 90% of all mortgages are at less than 4.5%, and that's going to keep a lot of people from moving around. That being said, we have a name for countries that don't deal with inflation problems, or worse, start to deal with them and then give up too early. The name we call those countries are banana republics. And that's where we would be if we didn't really handle a situation now. If it weren't for Reagan and Volcker in the late 70s and early 80s, we would be a banana republic right now. If it were, if Powell can hold the course, and the government doesn't pour in tons of money on top of the oversupply of money that is already there, and I'm talking about fiscal policy, we will get through this, and we'll get through it relatively quickly. How quickly? Sometime in 23, they'll start cutting rates. I think it's late 23. I think this is going to take longer than people think. But the slowdown, other than housing, which again just pushed demand back a little, it's the demand is still there. What we're going through is really pretty mild. Everybody talks about 2/4 of GDP. That's not the definition. I'll give you the exact definition. It's produced by a company called the National Bureau of Economic Research. They've been dating recessions for the last about 120 years. It's a significant decline in economic activity spread across the economy, lasting for more than a few months. Normally visible in real GDP, you've seen that. Real incomes, you've seen that. Employment, you have not seen that. Industrial production, not yet, but it's probably coming. And wholesale and retail sales. And there, it's not that wholesale and retail sales are slowing, it's the mix has changed. People are now spending more money, putting money in their gas tank and buying food, and that means they have less for discretionary items. But essentially, we're going to have a slowdown. It won't be terribly deep. It'll probably be a little prolonged. As long as the Fed doesn't give up, we'll get through this, and we'll be back to a strong economy again, sometime in 23. And later 23, I think. It depends. If the Fed gives up, we've got real problems. If fiscal policy keeps on dumping more money on an already over-moneyed economy, we've got problems. But other than that, we will get rid of inflation relatively quickly, and rates will drop almost as quickly as they've gone up. And so this is transitory. Don't listen to the news media. What you've learned from the last presidential election is you shouldn't be listening to the news media. And what you should learn from this particular slowdown in the economy is you shouldn't be listening to the media. Things really are better than they seem, but we have to deal with this problem or we become a banana republic.
So if you take what Elliot just said, and you sat with me for the last 8 weeks, there's a total disconnect between the local offices and corporate. Corporate is saying, no more earnest monies, no closing deals, no new deals, push it out, and if you can't, drop it. The local guys, every one of them, is basically saying, based on what Elliot just said, We have the population growth. We got the job growth. We have no standing lot inventory, no standing homes, at least at this point, inventory. A month and a half now, according to Cromford, of resale homes, and demand that is going to come back. So how do you time your current lot inventory, your current land deals? How do you time it to accomplish the timeframes that Elliott has? And there is not, what I've seen, have not seen, is price reductions in lots. I've canvassed every builder. There's 30 of them that control 90% of the market. They're actually starting to see price reductions in some supplies and materials, not so much in the underground infrastructure yet, but that's going to come based on a lot of the deals that have put on hold. You know, I give credit for Richmond American. It's in my new overview. On March, I think it was May 16th of this year, they dropped all our deals in French. You can talk about it. He called and apologized. I said, don't apologize, because I've replaced 3/4 of them already. But it's a very confusing time, but it's not, I've lived through 6 downturns. This is the 6th one. This is unlike any one of the other ones. It's not screwed up. You know, what's going to happen if Elliott's right is French is going to call me in November, go, oh crap, I need my lots back. And then we'll see what's still standing and see what the prices are then. But anyway, you guys can chime in. That's kind of what I've experienced the last 8 weeks.
Nate, when you say it's not screwed up, what do you mean?
Well, I mean, we're not going into this with 70,000 finished lots with 60,000 homes that were fake homes like 06. Okay. Those are fake jobs, fake homes, fake mortgages. Not now. This is a different Arizona. Now, if you're in Iowa, Illinois, not so good. But if you're in Arizona, based on my street fighter smarts and all the people that I talk to, which is a lot, you can tell by my voice, I think we are poised to just go crazy in the next 16 to 18 months.
Elliott, do you agree with that? The supply and demand, like the fundamentals in our state from a real estate perspective, are really not out of whack in any way, or even would suggest that we should be selling more?
They are out of whack. Basically, we don't have enough supply and we've got too much demand. We've now gone into a period where they're evening up. And so you're seeing more houses in MLS, and that's because they aren't turning over as quickly because there aren't as many buyers at the moment. But are we oversupplied like some people are implying? You know, that, where did I get this morning? Is this Tim Burns data, which is really very good data, I think, basically is saying no. Yes, things that it's less of a seller's market than it was, but it's clearly still a seller's market. Will that change? What I'm saying is, if it does change, and it really should have already, but it hasn't, it's transitory. And why do I think it should change? To buy the same house you bought last November, your monthly payment is now 62% higher. And that's mainly because of interest rates. Some because of prices, but mainly because of interest rates. And I think you're going to see builders do a lot of things in the meantime. I think you're going to see smaller houses on smaller lots and maybe cluster housing. You're going to see a buy down of interest rates, especially of 5.1 or 10.6 interest rates. But you know, this is the same set of builders that dealt with things in the late 70s, early 80s, when mortgage rates got to what, 18%, something ridiculous like that. These are smart guys, they'll figure it out. But the difference, as Nate pointed out, is that the supply demand situation is just as bad as it was a few months ago. It might get a little better, but all the people who would normally buy homes sooner or later are going to end up with homes at the end of this. This is not a permanent situation. The average recession since the end of World War II, except for 2008, and this is nothing like that, lasts 10.6 months. So unless something unusual happens, it should be over by the end of 23 and rates should be coming down. Can government do something stupid? Well, yes, the American Rescue Plan was stupid. Would another $500 million or $500 billion being thrown at the economy right now be stupid? Sure. Did the Fed learn its lesson from staying at the party too long? I really think they did. And I really think that they will be tough about this because the penalty for quitting too early is having to do it later when you've lost all credibility, which means it's going to be a lot tougher, and they don't want that. So I just think this is a situation we have to get through, and the demand on the other side is going to be huge.
And Frenchie, I'm going to go to you in a second and ask about what Richmond American's doing. But Elliot, when you're talking about that they quit too early, are you talking about they start pouring money in, or what are we, if we're not listening to the media, what is it that we're like supposed to be listening
Quit too early in Fed parlance means they continue to raise rates, and then they see that inflation gets down to 3.5%, because the real rate of inflation now is someplace between 5 and 6. And if you get down to 3.5 and say, okay, we can now ease up. No, all you'll do is restoke the fires. You have to really squeeze the heck out of things. And it took 2 recessions in '80. There was one in '80 that lasted 6 months. A year later, we were in a recession that lasted 18 months, which was at that point the longest recession since the Great Depression. I think the Fed understands that. I'm sure that that Powell reads the same books I do, including Volcker's memoirs, where he basically goes into great depth about the risks of quitting too early. And again, I don't think that's the way any Fed chairman wants to be remembered. Certainly not somebody with an ego like Powell.
Fair. Thank you for that. Okay, Michael, I wanted to know what, Nate just said that you dropped all your deals. What is Richmond American's position right now in the market? What are you seeing, and what are you guys doing? And before you answer that, actually, I was reminded by somebody that there was during COVID, at least, a major drinking game that would go on during lunch, during these sessions. And it was based on watching a lot of you who are on camera. And there were like ties to, if so-and-so eats, then you drink. If somebody does, and Nate has the rules. So turn your cameras on, because there's somebody here who's partying because of you.
Uh-oh. Yeah. No drinking at Richmond American Homes during work.
Or Rose Lager. Yeah.
No, thank you. I think, first of all, it's really important to kind of understand who Richmond is nationally and who they are to the Phoenix market. Richmond's the 5th largest builder in closings, year to date and last year. We're about 3rd in permits. We have a backlog of about 1,700 units. Nationally, we rank #1 and highest gross margins in the country. So that's a positive for Phoenix. There's a lot of pricing room in the Phoenix market. Cycle times is problematic. We probably rank middle of the pack out of 20 divisions nationally for Richmond. We're probably middle of the pack, 8th or 9th in overall cycle times. I'm wondering if cycle times have gotten better or worse. When I first started here 7 years ago, there were 90 to 120 day cycle time, 3 to 4 months. And now we're sitting at about 10 months nationally on average. So the supply chain disruptions and labor disruptions are really the main issue in the Phoenix market. Actually, at Richmond, we're kind of happy that there is a little bit of a recession, so we can catch up on the labor and supply chain disruptions to see if we can't get those cycle times down and return the money to our bank, which is our corporate headquarters. But it's a high volume business. But something else to understand is we are a build to order business. We do not build specs. We do not sell to investors. We have 0 build for rent. So it's a little nuanced when we're the 5th largest builder in this market and 3rd in permits. There are some things that other builders are doing to elevate their business in the local market that might garner them some more market share. But I really agree with what Elliot said and Nate said. This is going to be a temporary, shallow recession, in our opinion. David Mandarich and Larry believe the same thing. We did drop deals in May with Nate. We dropped a total of 15 deals. Now, to keep that in context, we did over 100 deals in the last couple of years. Spent over $600 million on well over 10,000 lots. So the drop, in our opinion, was minuscule to the overall investment in the Phoenix market, which is massive. One of the things that, I'll give you some real low, very low level metrics, so you guys can understand what we've experienced in our footprint in Phoenix is January, we sold 219 homes. February, 225. March, 152. And at the end of March is when interest rates increased, right? So that drop at the end of March was pure everybody freaking out that probably, maybe they couldn't afford the mortgage payment increase if they haven't locked in. April, 108. May, 129. So up in May. June, 98. July, 91 month to date. We'll go over 100. So we'll be up in July. Now, if you look at cancellations were 11% in January, 14% in February, 23% in March, 22% in April, 22% in May, 48% in June, and 40% in July. Year over year, last year, average cancellation pace in Phoenix, 6%. This year, 20%. Over the last 30 years of my career, 20% has been the average of cans. That's very normal. We sell, just like Nate resells the deals Richmond lost right away to other builders who need more market share, and they're benefiting from this downturn where maybe a larger builder wants to shrink their risk footprint. Other builders are capitalizing on it. On our cans, we're actually selling them within 3 days of canceling them. So there is a very healthy market out there, even in the face of everything we're talking about. We feel like if we were selling 200 homes and we have a 1,700 unit backlog, and originally we were looking at a 2,000 unit business, if this business goes back to 1,400, 1,500, we're incredibly happy with that type of volume. Maybe a more normal type of trajectory, one that our trades and suppliers can actually service, because right now they cannot service it. So there's an incredible bunch of positive things happening, even though the cancellations are elevated. And I personally believe, like, if you just get on YouTube and search, it's like worst recession in history, Great Depression beginning, Frenchie loses all his hair in 3 weeks. Everything is so hyperbolic. It's so over the top. But when you're actually experiencing this market, there is incredible demand out there in the face of all of the bad news. We have raised prices month to date. We have 31 active subdivisions in Phoenix. We've raised prices in 8 communities month to date. So even though our cancellations are elevated, we're reselling those cans, and we're finding demand out there. The real question is, we're trying to figure out where pricing is, because you can't buy land unless you know what your pricing and incentives are community by community. Out of the 31 communities, 8 are increasing, but the other communities, we're still trying to find it, and it's punch counter punch. In my opinion, I think we were the first to drop because we were probably the most aggressive price increasing builder in the Phoenix market. In 2021, we raised over $100,000 on average in every community that we had. And the first 90 days of 2022, we raised $70,000 in prices. That's $170,000 in a, 15-month period. Now I'm having to drop my pricing, and we have lowered pricing in some communities. Now, when I say that, I don't freak out about it. 80% of my East Valley footprint is in Maricopa, Coolidge, and Casa Grande. I'm going to have to kind of adjust and find affordability to get to demand. We don't really want to sell 8 a month. We would love to sell 3 to 4 a month at the highest gross margin we can find in the market, which allows us to pay the most for land that we can. And that's what we're seeing out there. Hopefully that helps. The one thing I thought was interesting, and I looked at it this morning, and I'm in the Phoenix market. We have 2 divisions here. I'm the regional president over Tucson and Austin, Texas, and Albuquerque, New Mexico. So I'm intimately involved in those operations. Austin, very much like Phoenix, has labor issues and has slowed down. If you're in tertiary or periphery areas, you're seeing it slow down out there a little bit more. In key core markets, you're seeing prices elevate. So if you can find land in key core markets like Mesa with Brookfield, you're probably going to have to pay a premium to be in it. So,
Hey, Frenchie, let me ask you a question. Of all the meetings and conversations I've had in the past 8 weeks, and this is really geared towards rental houses and the build to rent people, it's the concern of several of the builders that all these cancellations that are happening now are cancellations of guys that said it was their primary residence, but it wasn't. They were the investors looking for rents, and they're seeing the prices drop, and they're scared that, well, they're walking away from the deals. And some of the builders are saying that their sales that they were doing weren't 20% investors, closer to 35 to 40.
Yeah.
Can you react to that?
Yeah, definitely. I mean, if you look, MDC had their earnings call today, Richmond American Homes, and that was actually a question from one of the analysts, was with your cancellations, which seem elevated for Richmond amongst other builders nationally. And I think they're elevated because we raised on average 1% of every 2 sales. Our average price is 500 grand. That's $5,000 every 2 sales. Now, we don't sell to any investors. However, if somebody pays cash and says it's their second home, they're most likely an investor, right? Our cancellations are really buyers that have purchased in the last 90 days. They're not people that purchased beyond that. So in those last 90 days, we think there's probably a heightened, there's a larger group of investors that are out there. Now with us, they have to hide it. They're saying they're buying their second home and they're paying cash. We're making them put 20 to 30% down to get in, and we're not refunding their money. For us, we really manage it probably too tight, right? Other builders, they probably have an extended risk on that envelope because they are selling more and they're selling a portion of their business to build for rent. Some of them are like, that helps them catch up a little bit in the losses of this beginning recession. But for us, we don't see that much there, and we're happy. And the cancellations we're getting, like I said, they're not sitting on the market, they're reselling. And in some instances, in a lot of our communities, they're selling for more. So yeah, that's what we're seeing with us. Hopefully that helps.
Got it.
That's really helpful. And just so I'm clear, you said your cancellations are at like 20%, but that was what was normal before they took a dive and were sort of abnormally positioned?
Yeah, I mean, so it's, I started with Richmond, leaving Meritage 7.5 years ago. And when I got here, the cancellation rate was 28%. And that was right when the FHA had lowered their loan limits and the market took a little dip, right? And so we were experiencing more cans. So, over the last 7 years, we've seen that reduce as the market got really healthy and more vibrant. But the average has been about 20%. And for us, if we sell 120 homes and we end up at 100 homes, that's a really strong business in the Phoenix market. Would we like to do more? Yes. But right now, the elephant in the room for us is not that the market's not going to come back. We think this is going to be very brief. Nate, I think, said it feels like the COVID delay. It really does. I feel like it's going to kind of shut down a little bit, and it's needed because the real elephant in the room is not what's going on with us kind of having a little bit of a market correction. The real elephant in the room to us is the trade and supply side of the business, the labor side. If you're just an operator, meaning not somebody staring at a spreadsheet, but you drive communities all day long, and there's over 500 active residential detached subdivisions in the Phoenix area, if you simply drive around and you're driving the big dogs, D.R. Horton, Lennar, Taylor Morrison, who am I missing in there? Meritage, and the big up and comers, Landsea, Fulton, Ashton Woods, you will drive communities on a Monday through Friday, and you will see very limited trades on site working on homes. The demand has been great, but the amount of labor out there, it has not matched the robust market that we've had. And that's why we're seeing elongated cycle times. I feel like if this market decelerates, and if I were to define it, there's the Great Recession, I would call this the deceleration. It's decelerating a little bit. However, we actually need it for the labor and the trade to help us solve it.
I think we should stop right there because the deceleration should be we should replace all of our recession talk and all of that with the deceleration, which is actually a positive in our market in order for the trades to catch up with our demand. Thank you for that, Frenchie. And John Bradley from Brookfield, what are you seeing? Just give us kind of your overview of, do you agree with these guys? You've had such experience in our market, and would love to hear what your thoughts are generally. And we'll talk more specifically about Brookfield, of course.
Okay, well, first, I'm glad this is recorded because I need to go back and listen to Frenchie. I wasn't sure what he was getting at about losing all his hair. I couldn't figure out if that was a good thing or a bad thing. So we'll go back on that. And before I talk about Brookfield and us in the market, just to talk about the economy, what I would say is that Elliott is Elliott and I am not. I have a problem, and that is when I look at the economy, I tend to get focused on like one thing. I have a hard time getting off of it. And I mentioned this to Elliott the other day. But if you listen to Powell yesterday in his press conference, he talked about 3/4 of a point. And then he just kind of said very casually, and we're continuing to reduce the size of our balance sheet. And that's all. And you don't hear about it in the press. You don't hear about it almost anywhere. You might find something on Bloomberg if you find some guy that's really a nerd. But the Fed's balance sheet is at $9.7 trillion. And now they're actually reducing it. And when they reduce, about a little over a third of what they're reducing is mortgage-backed securities. So when you see the interest rate move that we just saw, if we were around 1.7 on the 10-year mortgage or the 10-year bond, 30-year mortgages were around 3%, 125 basis points, maybe 150. Today, the 10-year is 270, and we're at 5.5 to 5.8. So 300 basis points in difference. Why? Why is that happening? I think there's lots of reasons, but one of them is the Fed now has this tool that they've never used before to affect mortgage rates directly. So they actually can directly affect mortgage rates by how they handle the assets that they hold, which are mortgage-backed securities. And I just don't know what that's going to mean long-term for housing. I think it means rates aren't coming down. They're not going to let rates come down. They may not make them go up, but they're not going to let them come down. For the overall economy, what I would say is, I know Elliott said, Powell's going to try to manage this thing. I really think this guy that thought inflation was transitory doesn't have a clue. And I think that in terms of managing the balance sheet, they've never done it before. And they've tried to reduce it a couple of times and they stopped because it had a bad effect. So they didn't have the cojones to keep going. Now they're doing it, and I think they're going to keep going. And if they do, it's going to have one impact. And if they don't, it's going to have a huge different impact. And we just have to sit and take it when they decide what the direction is. So,
John, and I appreciate your comments. You've talked about interest rates, potentially not coming down, staying at the levels they're at today. Elliott, when you first, started your presentation, you talked about a group of housing buyer demographic of 18 to 29-year-olds, 46% of which are still living at home. What is that demographic doing? How are they going to get into this housing market? Are they just, waiting at their parents' house, waiting for rates to drop? Are they saving money? Well, what is it going to take to get them to be buyers again? Because I think we all agree they're needed.
Yeah, there's two things. And whether John's right or wrong, and I believe he could be right, I still think this is over by the end of 23. I really do. One way or the other. The impact of them going halfway down the road and then stopping would be so negative, I can't believe they do it. It would be so obviously negative. But what's going to bring buyers back are two things. One, keep in mind that millennials saw what happened in 2008, 2009, 2010, and they all think the housing market's going to crumble and prices are going to go through the floor. I do think that housing prices, if they do come down, will come down a little, maybe 10%, but I don't think it's going to crumble. I think the fluff will go away. I also think that where what John is talking about with liquidity in the system, there's actually there's a name for that. It's called a Minsky moment, when people all of a sudden realize that, oh my God, all the things we thought were positive were negative, and essentially venture capital goes away and anything risky goes away. It usually comes back. I'll also tell you that if you take a look at spreads historically, spreads are usually about 180 basis points over the 10-year treasury and to the mortgage rates, to 30-year mortgage rates. But during really tight markets like 80, 81, 82, like in the early 90s, like in 2008, those spreads skyrocket. So this is not abnormal. I think that spreads will come down once things get back to normal and inflation gets back into the twos. I think that that's going to happen sooner than people expect. The biggest problem I have is that John's right about is labor. And the Fed's got to squeeze an awful lot to get unemployment to go up because there's so many unfilled jobs. Do I think that's all doable by the end of 23? Yeah, I do. I'm a little concerned about what I read this morning about the Democrats getting Manchin to basically agree to pump another $500 billion in. You know, it's all bullshit, to be honest with you. But yes, I believe that that would be a real negative. Do I believe it will happen?
Call our Senator Sinema then. You just need to call our Senator Sinema.
Say that again?
I said, call our Senator Kirsten Sinema then, because she will stand in between whatever that.
Well, yeah,
means
well,
and
you mean
the-
call our senator, but that's all right. Yeah, that's another issue. But the bottom line is that could things get ugly between now and then? Yeah, but so far they haven't gotten ugly at all. Basically, that's what the only place they've gotten ugly is the housing market. And certain aspects of consumer spending, it's more where consumers are spending money than if they're spending money because they've got tons of cash. And it's also, are they getting scared because of all the media hype about, oh my God, Google's laying off some people. All right, so there's only 10 million unfilled jobs in America. Not exactly the end of the earth, the end of the world. So again, I can't believe that this is anything but transitory. Again, the Great Recession aside, the average recession since the end of World War II, and there have been 10 of them, last 10.4 months, from a short one of 6 months to a long one of 16 months. And that's what I believe you're going to fall in that range. And then things will get back to normal. If Powell didn't talk tough, if he didn't act tough, we'd be, like I said, we'd become a banana republic really quickly. Because once you get inflation into wages, it's very difficult to bring down. So I'm hoping he is going to be as tough as he says he's going to be. To me, I agree with John. He basically I'm putting faith in a guy who misdirected us to begin with, but it's a lot better than he was a few months ago. I think he had a rude awakening.
Frenchy, practical
John,
question
thank
for you.
For that,
Oh,
Elliot. John, let me just ask you about your master plans on Brookfield. Just what is going on there? What's Brookfield's position before we get away from that?
Thing is, we have 3 master plans going right now. Eastmark is pretty well winding down. We've sold most of the residential land, so we have Alamar and Avondale that we've sold probably a third of that to builders, and we've been open about 2.5 years, and we're just starting one in Apache Junction, just east of Eastmark. That's called Blossom Rock, and we've got about 5,000 lots there. So the reason I mention that is when we look at these things, they're long-term. Probably the shortest term that we do is maybe in the 8-year range. And something like Blossom Rock easily could be 12, 15 years. And as a result, there's always a recession. There's no way to do one of these without there being a recession.
This is a deceleration. This is a deceleration.
I'm sorry?
This is a deceleration, just to correct your
I'm
term.
sorry, having a deceleration. But it's nice to have the deceleration early and maybe get a little runway. And I do agree with Elliot, he and I spoke earlier in the week, and I do agree with him, but I really have no reason. I told him I had no really good reason for this, but I do think that all those buyers that he referred to, if they just have a little time and the 3% mortgages are kind of out of the limelight, they're going to realize that a 5.5% mortgage with decent pricing is actually a good reason to buy a house. And so how long does that take? And I was way off from what Elliot said. I said 12 to 18 months. Of course, he says the end of 23. So we're way off there.
That's
So,
good. Yeah, go ahead.
Frenchie, question for a builder, do you expect, you've said that you've got pretty constant demand, the cancellations are getting eaten right back up by other buyers. Do you expect that to continue and to ride out that next 12 to 18 months with your same buyer demographic, or is Richmond looking to pivot to, look at your product, even as you're streamlining, your supply chain and labor issues? What are you guys doing now?
It's a great question. Our footprint in Phoenix, 80% of it is entry level. So entry level, first time move up, right? So we're in those two platforms. 80% is in entry level. We're reselling it right away. Now, if you look at the top 5 entry level builders here in town, we're probably priced 4th or 5th above those, like DR Horton Express, KB Home, LGI. Meritage Homes Live Now, Ashton Woods, Starlight, we're priced above those. So, you're seeing more volume in those, and we're turning around and reselling those right away. So, like the other thing that we're seeing too, though, and I think it's a real positive, is we're also seeing an increase in option spend at our home gallery, and that's counterintuitive. So we may be doing some price concessions to garner more market share, and then when they get to our home gallery, they give it back and they option up the home. So, we're one of the only builders that kind of held onto our home gallery and not outsourcing it to a third party. So there's some other positive news in there. And I think the big thing is, when you look at the actual impact, and Elliot was just talking about it. So, and John, like if you looked back last year, average $450,000 house, 2.8% interest rate. This year, another $450,000, 4.75 right now, as of this morning, outside lender. Inside lender with Richmond is 3.75 to 4.75 with a 60-day lock. So we're actually more competitive than the outside lenders. And the one thing that has impacted our buyer out there, that entry-level footprint, is their payment on average has gone up $500. So it has priced the most price-sensitive buyers out of the market. And like I told you, we were probably the most egregious in raising prices over the past 15 months. And so we were probably the canary in the coal mine, kind of knowing that some of those buyers are priced out of the market. But there are builders priced beneath us, and they're garnering large market share. So, I still think there's going to be some fallout, but our footprint here in Phoenix is 80% entry level, and the balance of that is first time move up. And we resell those cancellations within 30 days.
Awesome. Hey, I would make mention, don't anybody leave right at the end, because we have a special, super special surprise that you may be familiar with from during COVID, but anyhow, we do. Okay, so I have some questions coming in, mostly by text to me, because nobody wants to put it in the chat. One is from one of the largest landowners in Arizona, the mogul, sorry to mention your name, Stacy Brimhall, and it's kind of to Nate, and asking, should we let any builders tie up our land now or wait until they hit the wall? And then will they pay more then? So give us some land advice against both. I don't know whose client you'll represent in that, but.
Well, let's put it this way. One thing that we didn't discuss is when the pandemic hit, everything stopped. No one knew what the hell was going to go on. And then 6 weeks later, the market went nuts. People realized they were moving here, the jobs, the population growth, the new way of living. And for 2 years straight, we sold homes. We didn't. The builders sold homes every month at record pace for 2 years, June, July, August, September, October, right? So we had 2 years of no seasonal buying or selling, I mean. So I've been doing this 42 years. And historically, from June to February, consumers pretty much retract. Now, I spent the last, and I'll answer Stacy's question in a second, spent the last 8 weeks in the middle of summer, and the builders progressively go, other than Frenchie, oh my God, our sales have stopped. Oh my God, this is terrible. The consumers aren't buying. Well, no duh. That's the way it's been for 40 years, okay?
Which is why you're in Coronado generally.
Well, I'm working my butt off, just for the record.
I know.
You look at it, is pretty much where I've been for a week. So anyway, to answer Stacy's question, if you have existing finished lot deals, you just push them out, because these deals are not closing, most of them, in the next 60 to 120 days. Push those deals out. The pricing is phenomenal. Those new lots, if they're older master plans, are competing against lots that were 500, 600, 700 bucks a front foot less than what these new phases are. So the master developers, the ones I work with, are saying, okay, I'm not cutting my price because infrastructure hasn't come down. So forget about it. This whole thing that we're all living together in, and all 300 of you are on this, we're all in this together. And that's pretty much the attitude I'm telling my sellers to have. Now, would I go commit to lots today on something that wasn't under construction or bid out or ready to go? Hell no, because those are probably fake deals. I would ride it out for the next 120 days, the next 6 months, and do what I'm doing, meet with every builder there is, know exactly, you got to communicate now more than I've ever done my entire life in my career. Okay. I'm on the phone for my clients every day, talking to these guys, because things are going to change. You know, I think August is going to be slow. I think come September, October, some stuff is going to come to a head. Other things will happen in the world. You know, Elliot's time frame of the end of next year, that means after the first of the year, when all the builders parade through my office and we go through their inventory needs, it's going to be fascinating. That used to be the first and second week of August. I don't think it's going to be the case right now. Right now, it's wait and see. But I would just do your homework, get your infrastructure bidded out, keep your plans going forward. If you're under construction, get them done, because whoever has stuff ready to go, Frenchie's going to call me up in about 6 months and go, shit, I need lots. And guess what? Who's ever got them ready is going to win, because the prices, in my opinion, are not coming down. All you land investors, I do not see price cuts yet whatsoever, and I don't think I'll see them. So
There you go. Thanks for that. And actually, Frenchie, why don't you tell us about your sales and traffic? And maybe Nate, you can tell me what the hidden meaning behind that question is.
Well, you know,
Such a good story.
yeah, it is.
No, it's really a good story. And it's like, we're almost about to be done. So you might as well just throw it out there, Nate.
I'm not doing it. Frenchie can do it.
I'm not doing it.
Frenchie's a public home builder. He can't
Hey,
see that. kind of
Elliot,
stuff.
wait, Elliot was there. He can tell the story.
Those were the early 2000s when everything went. You could do anything you wanted.
Okay, so we have like a private joke going on that no one can explain because
Yeah, I've never been
with a public builder.
I've
Nate's
never big
the same
fan
way.
I've never been a big fan of tracking traffic, just because traffic is, you know, is an illusion for a lot. Like a lot of salespeople will not put in the actual traffic because they're judged on their conversion. So I made a joke years ago with Elliot and Nate on a panel about how much I believed in in traffic, which I will not make the same joke again, Nate. But it was
Well, I
inappropriate.
love it. A secret joke in front of 300 people doesn't
Yeah,
go
yeah,
over
yeah.
unless somebody.
Well, the funny thing about this group of 300 is all of them already know what the joke was.
Somebody put it in the chat then.
You guys can call me up direct, whoever wants to know, I'll tell you.
Yeah.
They told me yesterday, and if I wasn't a lady, I would tell you.
But I will tell you, just like to re-answer the question, I mean, I will tell you guys, I thought it was really interesting that after interest rates went up in March, that it took our buying demand roughly 2 months to kind of build up confidence and get back to the market. So we saw an elevation in total gross sales in May after the March turn down. So, rates supposedly went up again, but, here the other day, you may see another small deceleration, but we think overall the, traffic has been, it's gone down, but our net sales activity and gross sales activity, we're actually pretty excited about where it is right now.
Yeah. My phone's blowing up the hook right now. People call.
Nice.
Good gosh. All right. So what about, so we're just a few more minutes left to kind of talk through. It sounds like we've got deceleration. We've got by the end of 2023, we think things will be normal. There was some mention that maybe this is just sort of like a COVID pause. And there was some thought about this potentially this disruption just being giving our market the ability to balance out a little bit more, and so it's not such a bad thing. Does anybody want to comment on that in the panel?
I'd like to comment on something that's not necessarily to that. I think for everyone on this call or the Zoom call, I think you need to really pay attention about all the new employment corridors, the 24, the Casa Grande Freeway corridor, the Grand Avenue going up north, believe it or not, the White Tank, west of the White Tanks, the 85 going south. There's a 360-degree situation where new employment's going to start popping up. And I've beat myself when you put the restrictions of water situations, in the Arizona Water Service Area, Buckeye, and you see where the growth patterns are and where you can grow when we do take off, hopefully at the end of 23. The world's a different world than John and Elliot and I have seen. I mean, it has changed in the last 5 years, and the acceleration of those changes are going to be so important, because getting builders down to Maricopa, down the Santan corridor, that's where you're going to have to go. And there's going to be new employment corridors that have changed the world.
Yeah.
I give that advice.
And it's going to be different product. There seems to be a bunch of chatter about banks. I worked for a bank for 18 years, for those of you who are very old and remember back that far. And what we used to tell people about banks, a bank is somebody who'll give you an umbrella when the sun is shining and want it back when it starts to rain. And they are in the middle of their Minsky moment, and they want their umbrella back. And this is typical. It happens in every cycle. Nate's been through 6. I've been through a bunch, and this is absolutely normal. Don't get hung up on these things. They are just the normal cyclical bullshit that you go through. And keep your eye on the ball, and the ball is, what is the underlying demand, and what has to happen for rates to finally come down again. And both those things are positive. I don't believe that rates can stay high forever. The economy can't function. And the higher they stay for longer, the more probability is that they'll beat inflation. But I don't think they have to stay high for that long. People just have to be convinced that the Fed will stick to it. And as long as they don't back off, and as long as you don't get these $500 billion or $1 trillion spending sprees by on the fiscal side, will be in good shape. So I see nothing in this cycle that's abnormal, other than it might take a little longer because the underlying economy in terms of employment is so strong.
Awesome. For everybody, don't anybody go anywhere because we have a surprise, but the 4 of you guys were incredibly insightful, and I think came just at the right time where all of our clients were asking questions, and I know everybody at the chatter in the marketplace was just super confused. So we thought we'd use this tool that we developed during COVID, this power lunch, to make an impact on the market and try to help calm things. So I think with that, I want to say thank you. We're super grateful, Cameron and I and the law firm here at Rose Law Group.